Good morning. It is Friday, March 20th, 2026. This is your deep dive daily briefing. I am your anchor, Cora, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has reached a moment of critical escalation. Following the reported death of the previous Iranian supreme leader and the subsequent hardline stance of the successor regime, the region remains in a state of high-intensity conflict. Overnight, United States and Israeli forces continued sustained air operations against Iranian military infrastructure, specifically targeting long-range missile sites and command centers across several provinces. This military pressure comes as the international community watches the deteriorating humanitarian situation in Lebanon, where displacement has reached record levels. While certain diplomatic channels in Geneva remain open, the rhetoric from Tehran suggests a readiness to endure a prolonged confrontation, leaving the prospect of a regional ceasefire in a state of extreme fragility.
Transitioning from the front lines of conflict to the broader global economy, the narrative is being driven by a profound sense of uncertainty as central banks navigate a new era of structural volatility. Despite the immense pressure from the energy crisis, the International Monetary Fund has maintained its 2026 global growth projection at 3.3%. This resilience is largely attributed to the adaptability of the private sector and the front-loading of trade activities by major importers ahead of anticipated policy shifts. However, the visceral impact of the de facto closure of the Strait of Hormuz continues to filter through to consumer prices. Crude oil remains stubbornly high, trading well above $100 per barrel, which has prompted many advanced economies to implement emergency fuel monitoring. In Southeast Asia, nations like Thailand and the Philippines are seeing a significant impact on their manufacturing margins, as the cost of energy-intensive production rises alongside increased freight rates.
In the realm of finance, all eyes remain on the fallout from the Federal Open Market Committee meeting, which concluded late yesterday. In a move that market participants are calling a hawkish hold, the Federal Reserve elected to maintain the federal funds rate in the 3.5% to 3.75% range. The updated summary of economic projections suggests that while the Fed acknowledges a resilient labor market, it remains deeply concerned about the inflationary fire fueled by energy costs and new global trade tariffs. Investors are particularly focused on the dot plot, which now indicates a more conservative path for interest rate cuts in 2026 than previously anticipated. On Wall Street, this cautious stance has led to a period of consolidation, as institutional capital weighs record-breaking corporate buyback authorizations against the reality of higher-for-longer borrowing costs in a wartime economy.
Turning our attention to the technology sector, the focus remains on the massive build-out of artificial intelligence infrastructure and the arrival of the agentic era. During the ongoing GTC 2026 conference in San Jose, industry leaders have confirmed that the AI inflection point has officially transitioned from generative models to autonomous agents. NVIDIA has showcased its new Blackwell Ultra architecture, designed to deliver a 50-fold performance increase for complex agentic workloads. Simultaneously, major cloud providers like Microsoft and Google are reporting a record surge in capital expenditures as they race to secure the energy and hardware required to sustain these localized tech ecosystems. However, this growth is facing a physical ceiling, as AI data centers are now projected to require an additional 92 gigawatts of electric power globally by next year, prompting a radical rethink of energy procurement and the potential for dedicated power generation facilities.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are currently facing their most severe stress test since the pandemic. The Strait of Hormuz remains in a state of near paralysis, with maritime traffic having plummeted by over 80% since the conflict began. This blockade of a waterway that handles 20% of the world liquid energy has forced every major ocean carrier, including Maersk and MSC, to officially suspend transits and reroute vessels around the Cape of Good Hope. This detour adds up to 14 days to voyage times and has triggered a massive spike in war risk surcharges, with some fees reaching $4,000 per container. Logistics providers are warning that even if the strait reopens soon, the ripple effects on port capacity and equipment availability in hubs like Jebel Ali and Salalah will be felt for months. As the conflict spreads, 72% of trade professionals now identify geopolitical instability as their primary enterprise risk. That concludes our global briefing for today. Thank you for joining us. I am Vivian.